Well, good morning, everyone. Thank you for joining us on the final Munro Partners webinar for the year. My name's Stephen Taylor from GSFM, and we appreciate you giving up your time today to listen to Nick and hear some insightful comments around the year that was, and more importantly, what we're looking at seeing with markets and the Munro funds throughout 2025. Now, just before I hand over to Nick, just a couple of quick points. It's been a great year for the suite of 4 Munro funds. More recently, we've had the 1-year anniversary of the Global SMID Fund, which has had a fantastic year in its inaugural time. And it's been very pleasing for us to have very wide platform availability for all the Munro funds. We also have the 3 ETF structures for those of you that prefer to access the funds in that regard. And just yesterday, it was really pleasing for the Munro SMID Fund to be awarded a recommended rating from Zenith Research, which is fantastic given it's just over 1-year anniversary for the fund. So given that we're under about a 45-minute time frame today, what I'll do is I'll hand over to Nick, and anyone that has any questions, please just pose them through the Zoom Q&A button, and Nick will speak for about half an hour. Then we'll come back and do the Q&A and finish up in about 45 minutes. So once again, thank you for joining, and I'll hand over to Nick.
Yeah, thank you, Steve, and thank you very much, everyone, for dialing in today. So my plan here is to do a couple of introductory comments just to, remind you who we are and what we do. Then I'll basically give our market outlook for 2025, which I think is what a lot of people would like to know. And so I'll basically talk to you about how we think about our market outlook, and then I'll talk to you about how all our various funds are positioned, and take some questions at the end. And thanks very much, everyone, for taking some time out of your Friday. So just really quickly about Munro, just to remind everybody, Munro Partners, was set up 8 years ago to be your global growth investment manager. So we do global equities and we do growth. We're running roughly $5 billion in assets under management, and we have 30 staff members here in Melbourne, Australia, and 11 in the investment team. Just very quickly to remind everybody, this is effectively our journey of our asset split. So we started this fund, with just a few of us with $20 million under management back in 2016, and it's grown to nearly $5 billion. The majority of our funds are still very much in the absolute return strategy, which is the blue bar there, and that is the Munro Global Growth Fund, which a lot of people have supported for a long period of time, and thank you very much for that support. But it is important to flag that we do have our long only strategy, which is the orange bar. So that's the same ideas in the absolute return fund, just long only without the downside protection, and that's become more popular over the last few years. And then since then, we have also launched the climate strategy 3 years ago, which is to invest in the enablers of decarbonisation. And as Steve mentioned earlier, we about a year ago launched the SMID cap strategy. All of these funds are effectively running under the same process, which thankfully I won't go through in detail today because it's an outlook one, and they're all being run by the same investment team. And the best way you should think about these funds, just very clearly, is sort of on this curve. And so this is just a slide we put together to help you to think about the products we're going to be talking about today, and think about how you can access what we're talking about today. And so along the bottom bar, we have our risk objective. That's a beta number, is what we're talking about. And on the left, you're talking about the return objective. And so all of our funds should and are, thankfully, do more than 10% per annum returns after all fees and expenses. The absolute return fund does 10% per annum after all fees and expenses with a beta below 1, roughly 0.7. And it does that through the cycle. It effectively smooths the cycle for you as a growth equity product. Very suitable to people who, think more about absolute returns than relative returns. Definitely very suitable for people sort of over the age of 50, etc. The concentrated product is the same ideas, just without the downside protection. So it's going to get you a slightly better return over the journey, but it's going to do it with more volatility. So you're looking at volatility above 1, excuse me, because most of the stocks we invest in have a beta of above 1. And then lastly over here, you have the SMID cap fund and the climate leaders fund, and there you're running at sort of a beta of sort of 1.2, 1.3. We think of these very much as satellite strategies. So again, the returns should be better, but the risk, the volatility is slightly higher. And that's what you should be getting through the cycle from our products. And importantly, as we sit here today, all of the products are actually basically doing what we would say at Munro Partners. They're doing what it says on the tin. So our absolute return strategy is compounding at 13% per annum since inception, has that beta below 1, has the different upside and downside capture ratios. But importantly, if you are interested in our long only strategies, on the right here, you are seeing, yes, that slightly better performance, but also that slightly higher volatility. And basically, you know what's most suitable for your client or what's most suitable for yourself throughout the journey. And very pleasingly, you know, all these funds have obviously had a very strong year in the last year. But as you'll probably hear today, we think that's more closer to the beginning than the end. You know, this is the returns you do expect as you start a bull market. The best returns you always get in the first year of a bull market or the second year of a bull market. But if you look at our 3-year numbers, they're sort of in line with our long-term averages. And so that would suggest that, you know, we're not at the end of this bull market yet. And I'll talk a lot about that today. But pleasingly, funds performing well, all of them doing what we expect them to do on the tin. And for those investors on the call who've been with us a long time, we thank you for our patience for us to get back to this point in the cycle. Okay, last point, the investment team. I better drink some water. Important thing just to flag, all of these funds are run by the same investment team. So we're running one process across all the products. The same investment team is contributing ideas to these products. They are all growth equity ideas. There are just different people managing these products. Chow has final call on the SMID product, James and myself on the climate product, and myself for the all cap products. And I should also just flag, all of these funds are now recommended at Zenith. So obviously SMID got recommended after just 1 year, but Climate also got upgraded to a recommended fund last year, which is very, very pleasing and a very good support and very endorsement. Thank you to Zenith for endorsing those products. Okay, and then just lastly, just in terms of introduction, because I'm just going to do 1 or 2 slides here on how we invest, because I'm going to keep referring back to as we talk about our outlook for 2025. But it's just important to really quickly just level set on how we do actually invest. And so the first thing just to remember is that here at Munro Partners, we think there's only going to be a few winners. We have this very simple philosophy that stock markets are essentially made up of thousands and thousands of mediocre companies, and just a handful of really exceptional ones. Your job is to find those exceptional ones. And so what I've shown you here is this is the best and binder data that many people have seen me show over the years, but literally only 4% of all companies listed generate all the value of a stock market. And the top 50 or 100 generate more than half than that. These are the top 50 or 100 over the last 90 years in the United States. And you can see that all of these companies are generating fantastic annualized returns over a long period of time. But they're all created by big structural changes, whether it's digitalization or big box retailing or quick service restaurants or you know, smartphones, etc. So find the big structural change, find the winner. And so at Munro Partners, rather than think about going over or underweight sectors or countries, we're essentially just trying to identify these big structural changes. If you identify the structural change, you'll identify the winner. And so our philosophy is very much focused on identify the structural change and identify the winner, and then run very disciplined risk management over the top of that, because inevitably you're probably going to invest sometimes not in the winner. If you do that over and over again, you're a reasonably good chance of getting the double-digit returns through the cycle. How we've done that, and I won't go into this in detail, but please don't be afraid to use the QR code that I showed you earlier on the slide here, which is just here, or go to our website to go through the process. But how we do that is we ultimately don't focus on the whole global equity universe. We just focus on a structurally growing universe. These 1,000 companies that we look at that have that potential to grow structurally over a long period of time. We split them, as you know, into these different areas of interest. We'll talk about some of them today. The second thing we do is we think there's 6 great qualities to a great growth company. That's growth, that's the ability to leverage that growth, it's durable growth, it's good ESG, it's controlling shareholders or highly aligned management, and it's great customer perception. These 6 great qualities, after we find the right structural growth area, inevitably lead us to the great global growth company. And then obviously we do our own maths, our own bottom-up models to prove that these companies can double within 5 years. So no stock will ever actually get into a Munro fund unless we can mathematically prove that the company can double within 5 years. And then the last thing we do is obviously our very disciplined risk management, the stop loss process that a lot of people know we follow, that works very well, that creates this great picture on the right. These are our top 10 winners since inception. And these are our top 10 losers since inception in basis points contribution to the fund. And so if you just think about this really simplistically, and what I've been trying to talk about very quickly here today, and happy to go through as we go through the outlook, your job is to find these few winners and run them for long periods of time. We found NVIDIA 5 years ago. We found Amazon a decade ago. We found ASML a decade ago. We found Constellation just 2 years ago. Find these companies and run them for long periods of time. But most importantly, be very militant about your mistakes. If you do that well over a long period of time, you can work your way towards those few winners to find those exceptional companies that will get you your double-digit returns and eradicate your mistakes along the way, and you mathematically produce 10% per annum through the cycle. That's how all our funds have done it, and as I sit here today, happily showing you more than 10% per annum through the cycle for all of our funds. So that's a very short update as to who we are and how we invest. Okay, and I managed to get that done in 10 minutes. So now we get to the bit that you actually want to talk about, or that you're probably most interested in. What is our outlook for 2025? What do we think is going to happen to markets? It's obviously been a very strong period of performance the last year for our funds and for markets. And I think most people are sitting here today and saying, well, cool, can this continue? And I think the best way to think about this is to take a big step back. This is how we think about markets at the moment. So this is my entire investment career. I've been doing this since 1995. This is the S&P 500 over that journey. The grey bars are bear markets. There was one in 2000 and 2002. There was one in 2007 to 2009. There was obviously one here in COVID, and there was a really big one back in 2022. And so it's important for everyone to understand that we are just coming out of a really big bear market. You mightn't have felt it here in Australia, but I can assure you in the growth equities world, this was a big bear market in 2022. The NASDAQ fell more than 33%. The median stock in the NASDAQ fell more than 50%. So this was as bad a bear market as we probably went through in the dot-com crash. And like any bear market, it has effectively cleansed the system. Interest rates went from 0 to 5% very quickly, and we effectively cleansed the system of all the excess valuation in the markets. We didn't end up having the recession that a lot of people thought, and that's now behind us. But the reality is the bear market is finished, and we think we are now firmly back in the next bull market. The other thing to say is we're probably only 2 years in to a bull market that should last at least 5 years. And the reason why I say this is because what generally happens after you come out of a bear market is everyone starts to try and predict the next bear market, but what you end up having is a long period of calm. And this long period of calm happens because you've cleansed the excesses. Today sets up very much the same way. You've cleansed the excesses. Interest rates are at 5%. And now central banks sit in this position where they can basically manage a long and sustained upcycle. And they can do that by either cutting rates or not cutting rates. It doesn't really matter how fast they cut rates. It just matters that they can cut rates over this long period of time that we have now in front of us. And so we think very much we're in the next bull market. We think we're 2 years into it, and it should last at least 5 years. And so we have a very firmly positive outlook as we go into 2025. The other reason really to think about this really quickly, and maybe just to remind people, is that I know that around you things are not as good, right? The economy is not great in Australia. The housing market is difficult in Australia. But the thing you have to keep reminding yourself is that the stock market is not actually the economy. In Australia, in the United States, the S&P 500 is not the economy. It's the best 500 companies in the United States and generally the best 500 companies in the world. Their earnings have actually been accelerating now for 2 years. These are 4 companies that I'm showing you. The lines are their blended forward EPS. And all of these companies got back to earnings growth in 2023. NVIDIA because of AI, Amazon because of AI and cost cuts in its retail business, Eli Lilly because of GLP-1s, Google because of cost cuts. And so all these companies are now growing again. And so the stock market is not going up because it thinks it's rate cuts. The stock's going up because the earnings are going up. And the earnings are actually accelerating. And if anything, that acceleration is now going to broaden out. And the reason why it's going to broaden out is because the question you all want to know is Trump 2.0. Okay, so again, just to take a step back and again, just to level set, you know, whatever your view is of Donald Trump, and I know everyone has a view, it's a subject of dinner party conversations. The reality is he has won a firm mandate. He's won a mandate, he's won the popular vote, he's won the lower house, and he's won the upper house. And so we are going to get Trump policies now for the next 4 years, and they're going to be passed. From that point of view, you have to understand that these are going to be very much America first policies. So our view is don't overcomplicate this. Invest in America. Secondly, don't overcomplicate that this is going to happen. They're going to be corporate friendly policies. They're going to be policies around US tax cuts. They're going to be policies around trade wars or US onshoring. They're going to allow more mergers and acquisitions. And I think the big one out there is this regulatory rollback, or this DOGE that you're seeing out there, that obviously Elon Musk and other people are looking at. The reality is Trump is very anti-regulation. He is very less regulation or deregulation. You can see that from the previous term. And so what you could generally get here is obviously some mathematical upside from tax cuts and onshoring and mergers and acquisitions, but you could actually get quite a large productivity upside from this regulatory rollback. And while some of this stuff might not actually happen, right now today, the market's going to believe it's going to happen. And it's going to believe it's going to happen for at least the next year as Trump basically brings his team into place. The other thing to think about this, and this is just some good data that Bank of America published recently, is that basically productivity is the natural elixir for equity markets. This is the sort of the magic dust that allows equity earnings to go up. What we're showing you over here is revenue per worker, which is actually inflecting for the first time in 20 years. So we've had 20 years of no productivity growth. This is just the United States, but it's now starting to inflect higher. You could argue that's AI. You could argue that's software spending, etc. But you could also argue that Trump's going to help that. And he's going to help this productivity get better. He's going to help America move faster. He's going to help America first policies. And this has happened before in the 80s and the 90s. And I don't think people should discount that this can't happen again in the next decade. What we're showing you on the right here is the earnings of the S&P 500 normalized over a long period of time. It's a huge advertisement to what I said before. Stock market's not actually the economy. The earnings grow. You want to own the US. It's effectively a warrant on human innovation. And what you can see here, particularly in the 80s and 90s, is you ran well ahead of these periods. And so we could be in for a period of accelerating earnings growth, even ahead of the long normal averages. And so from our point of view, we think 2 years into a bull market, Fed can cut rates, which will help support the market. They don't have to, but they can. And Trump is going to be very stimulatory for earnings growth. So this is a reasonably good setup. The last problem that everyone has is effectively, obviously, valuation. And valuations are high. But it's important to flag that a lot of that high valuation is being created by these exceptional companies in the United States. And so what a lot of people talk to me about the United States is, why does the United States keep winning the whole time? The reality is digitalization has created these huge companies in the United States, and they are effectively winning from the rest of the world. People know these companies as the Mag 7, but the simple way to think about this is Microsoft isn't the software company in the United States, it's the software company for the world. Google isn't the software company, isn't the search engine for the United States, it's just a search engine for the world. Meta's the social network for the world. And so they're effectively been taking share from the Fairfaxes and the Channel 9s of the world for a decade now. That makes these companies, quite frankly, magnificent. And so from that point of view, they do trade on these high multiples, but it's justified by their high earnings growth. And what that's doing is it's sucking up the multiple of the entire S&P to 22 times earnings. But if you look on the right, if you look at the S&P equal weighted index over the last 10, 15 years, the equal weighted index, if we take that effect out, is roughly 18 times earnings. And so the broad market is not out of bounds here. The broad market is not expensive. We are not in a bubble. We have an economic recovery that is just beginning and one that will broaden out. And so ultimately you have the perfect ingredients, we think, for the third year of what should hopefully a 5-year plus bull market. And so that's how we've positioned. So maybe just working forward, that is our outlook for 2025. Very much US focused, very much third year of a bull market, very much a broadening out of the earnings recovery. And our job as your growth investor is to identify that earnings growth, and that earnings growth will ultimately get us our share price growth. That's essentially what we're trying to do here. So what I'm going to show you now is how we've positioned the main funds, so the Munro Global Growth and the concentrated products. And at the end, I'll show you similar positioning for the climate fund and the small cap fund. But this is a slide that appears in our monthlies and our quarterlies. And it essentially shows the areas where we've invested the fund today. So the area being climate is roughly 15% of the fund, the number of holdings, and an indicative position size. Below that, we're showing you things like high performance computing, the number of holdings, and indicative position size. And then we have digital enterprise, which is cloud. We have some of our infrastructure stocks, which I'll talk about in a second, some of our security stocks, connectivity, digital media contact, and healthcare. And so what we've been working at here at Munro for the last year is to broaden this fund out. We've effectively added, a year ago, this fund was very AI centric. In the last 6 months, it's become much more broad-based. And you can obviously see that by how the fund has performed for this Donald Trump election. And so from that point of view, we are positioning, as I said, for this broad earnings recovery next year. What I'll do now is I'll just run you through a couple of these and why we think that there is a strong structural growth. That structural growth will basically equal earnings growth for the companies that benefit, and that earnings growth will continue to drive the double-digit returns that we're looking to achieve here. So first big area to focus on is high performance computing and connectivity. So just to diffuse all the AI questions at the end, or maybe diffuse the NVIDIA questions, we still like AI. Even though we have broadened out this fund, we still like AI. We still think that we are roughly 2 years into this AI opportunity. Clearly, some of this has played out, but as I'll show you in a second, we think there's a lot more to go. And the reason why we say that is this is a picture we showed you about a year ago. Basically, AI is at the point now where you're going to be building thousands of applications. All of these applications are going to run on the cloud, and the cloud's going to need to invest heavily in semiconductors to run these products. Everybody on this call has probably experimented with AI applications. Everywhere we go in the world, we just see more and more AI applications being developed, and ones that are ultimately, massively disrupting industries or allowing certain companies to beat versus their competitor. So we can't see any reason why companies won't still invest in this technology over the next 3 to 5 years. So from that point of view, the semiconductor market is going to its fourth era, which is the area of artificial intelligence. This is a slide we've shown you for years now. We have said for years now, NVIDIA would become the biggest company in the world. NVIDIA has now become the biggest company in the world. We still don't think this is the end. Clearly, it has come a long way, but as I'll show you in a second, we do think there is more to go here. The reason why is because what people are doing to get these AI models to work is they are building these large GPU clusters. To give you an idea, ChatGPT-3 was built on roughly 10,000 NVIDIA A100s. ChatGPT-4 was built on roughly 25,000 H100s. When we go to the States now, we meet companies that are trying to build 100,000 GPU clusters. Tesla's just built one. Facebook's just built one. And on top of that, we now see companies working towards building million GPU clusters. So these supercomputers that are effectively going to train these mega AI models that are basically going to run all these applications that are coming. And every company in the world is now gearing up to build these million GPU clusters. We know this because they're basically contracting whole nuclear power plants to do it. And so many people would have read about Microsoft reopening the 3 Mile Island nuclear power plant. That's basically a whole gigawatt of power for data centers. Amazon did a deal with Talon for a whole gigawatt of power for data centers. And it doesn't matter where you go in the world, you can see this. There's 10 billion happening from Oracle. You can see 8 billion in Thailand, 3 billion in South Carolina, 11 billion in Indiana, 10 billion in the UK. The money is coming, and it's all coming to gear up for these big clusters. What we're showing you here is data center capex from the big four, which is obviously growing up massively. It's shifted aggressively to NVIDIA and parallel processing the last few years. We don't see any reason for this to stop. Clearly, a lot of it's happened, but there's nothing we can see to suggest that it's not going to keep happening. And so we still think this is a good area to invest. Moving along, and then the next question everyone's going to ask me is like, well, what's the ROI on this? Who's going to use all this stuff? How's it going to work? What we see everywhere we go is more and more companies using this technology to beat their competitors. We see this very much in the software area of interest, which is digital enterprise. And we are starting to see it in things like digital media and content with companies like Apple and Facebook, who are basically leaning on these models to basically outwit their competitors or outcompete their competitors. Just to give you an idea of some of the revenue models we're seeing out there and why we think this is going to be so big. The obvious one that you all know about is Microsoft Copilot. Lots of us are now paying an extra $30 a month for a Microsoft Copilot subscription. That's the obvious one. And we're seeing a lot of software companies lean into that. But the cool thing we've been seeing in our trips is all these other applications. And so it's important to remember that AI isn't just like a mobile phone. It's not something that's just going to affect the software industry and the tech industry. It's going to affect every industry. And so if you think about this quite clearly, and I've got a couple of videos here. This is something NVIDIA showed us, but if you think about it, like if the AI model can watch a video and turn it into text, or an AI video can watch a video and turn it into code, then it can watch a video and turn it into code to effectively code a robot. And so what we're seeing now is effectively robots that are able to be coded just from video. So you can watch the video, turn the video into code, and then help code the robot rather than have to type all the lines. You can see this from robots, etc. You can see this across the industry. You see very similar things happening. So this is in the digital media and content industry. You've got video games with effectively NPCs or non-playable characters in them, whereby the non-playable character, you can just plug it into a large language model and it can start talking, and the words will perfectly follow that. And we're seeing this very much, obviously, in the autonomous car driving industry, where autonomous driving is doing leaps and bounds of development because of these AI models. And so the simple way to think about AI, and the reason why we're not jumping off this trade or this investment just yet, is it's just going to be much, much bigger than what everyone thinks. You're looking at data center spend of 250 billion. It gets the global economy of 85 trillion. It's not just going to be co-pilots and chat GPTs. It's going to cover robotics, security, MRIs, you name it. Every business in the world is going to lean into this technology, and we're effectively only 2 years into this opportunity. And so we do see this one playing out over a number of years. Some of the obvious winners we've seen in the last few years are companies like Facebook that are using these GPUs to increase the eyeballs on their site. Some would have seen the meteoric rise of app loving. It's doing a very similar thing. And so advertising companies, media companies are all leaning into this technology. Last thing just to point about on AI is obviously this has intersected with our climate area of interest. And so in the last 12 months, we have been investing in decarbonisation for a long time, but in the last 12 months, we've seen these two things intersect. Climate, we like the climate opportunity. It is the biggest opportunity position in the fund today. Seems counterintuitive with Donald Trump being elected, but the reality is all of these companies are benefiting from the massive power needs that are required to develop this AI. And they're also benefiting from the onshoring that's going on in the US, i.e. bringing all this production back to the US is creating all of this electricity demand. This is the $50 trillion opportunity. These are a couple of the companies we're invested in today. And obviously you can see from our climate fund's performance in the last year, this has obviously created a huge differentiated source of alpha for us in the last 12 months, basically because we understand how this is going to play out. Maybe to give you a bit of insight, just to think about this in terms of a bit of how we're seeing it, your standard chat GPT query uses roughly 10 times the power of a Google search. All of that data center capacity I talked about is all being built out, and it's effectively inflecting power demand in the United States. And power demand in the United States hasn't gone up for 20 years because, of efficiencies, but now it is actually inflecting positively. And so what that means that anybody who's in that power supply chain is benefiting from this. And here we're looking at companies that are effectively either supplying data centers or supplying the grid with either medium voltage transformers, liquid cooling equipment, the ability to install HVAC equipment, and then lastly, the ability to supply renewable power. And it's important to understand here that a lot of the investment that's being made here is being made by companies that actually have some of the strictest net zero targets in the world. And so they're bigger than nation states. They're spending billions of dollars, and those billions of dollars have to be done in a net zero way, which has obviously led to the nuclear industry benefiting. And so one of our big benefit issues of the last year has been Constellation Energy. This is our second best performing stock of the year behind NVIDIA. From our point of view, they own installed nuclear power in the United States, and we're seeing this grow dramatically over time. The value of this asset is growing dramatically as these companies try to build the data centers next to the nuclear power and pay a premium for that nuclear power to get the renewable energy. And we see this across the climate area. And so these are all areas we are positioned in today, have been positioned in most of the year, and continue to be positioned into next year. Last thing I'd just say about this AI area, and we'll talk about this in the next 10 minutes when I talk about the other parts of the fund, is we just talked about the obvious stuff, basically cloud companies investing on semis to create software products and locking up power. But the real AI opportunity from here, a lot of this is actually played out. The real opportunity is down here, is what are the companies that are going to leverage this technology to help make their products better. And I'll show you a couple of these in a second as we go through some of these other areas of interest. But look, as promised, we have broadened the fund out. So we have broadened the fund out this year. You can now see infrastructure is a 10% position in the fund. Here we're investing in companies that we think are going to help do a lot of this onshore rebuilding in the US. We're investing in companies that are going to help build these data centers that I talked about. We're investing in companies that are going to help build out all this electrical infrastructure as the US effectively goes through what we think will be this, America First boom. This has actually already been happening for a little while already. So it's important to flag that the US has the Infrastructure Investment and Jobs Act. It's roughly $1.2 trillion. Roughly 30% of it's been spent already. We would expect this to get supercharged over the next couple of years. But you also have the Chips and Science Act, which has basically been about bringing semiconductor production back to the US. Here I'm showing you the TSMC Arizona chip fab, which is roughly $40 billion of investments. With a bit of luck, Donald Trump will open this one in December. And they're going to expand that again as they bring chip manufacturing back onshore. And we still have the Inflation Reduction Act. We'd expect more of these to come. These are some of the companies that we found in the last 2 years to invest in this. This one was actually found in the Climate Fund originally, and we've graduated it to the main fund. There's a company called Comfort Systems, small market cap company, effectively a Texas-based HVAC construction company. And here you can just see this massive inflection that's happening in earnings as more and more stuff comes back to the US, but you're effectively paying the same multiple for the journey. And so we think this company's at the start of this structural growth journey. That structural earnings growth should continue. If the multiple stays the same, that's going to drive the double-digit returns of our fund. And every time we talk to them, their backlog of business is just getting longer and longer and longer. Another company in this area is a company called CRH. It's an Irish company, but has a large part of its business based in the US around quarries and manufacturing. The beauty of these quarries is you have to sell everything within an 80-kilometer radius. Again, you're not, coming back to what I said earlier, you're not having to pay high multiples for these companies. They're trading at their average multiple, which is roughly 15 times, but their earnings are inflecting, and their earnings are going to inflect for a number of years as this onshore boom continues in the United States. Maybe one more area before I wrap up. The other area I'll just flag here is security. This is, again, another area that's come into the fund over the last 12 months. And here we're basically investing in homeland security and defense, okay? So clearly a big part of this US election has been border control and public safety. This is a big part of every election, quite frankly. It will be here in Australia also. What we're trying to do is invest in companies that help here on the safety and security front. So what I'm showing you on the left here is US state and advocate spending over the last number of years. It's growing at an accelerating rate, i.e. people need to invest more money in their police forces to keep their communities safe, to ultimately allow them to get re-elected. On the right, this is obviously a global dynamic from a security point of view as well. Europe is underspending versus its NATO targets. The US is going into an isolation phase. And so all of these companies are going to have to catch up with their defense spending. And so the companies we're investing here are a combination of Rheinmetall, which is a German defense company, and Curtiss-Wright, which is a defense company, also with a nuclear business, and then public safety companies like Motorola Solutions and Axon. One idea here is Axon. Again, people in Australia would be familiar with this. Axon effectively makes tasers and body cameras, and basically all the software that's attached to that. The police force here in Victoria and New South Wales have these cameras. These cameras are very useful in terms of filming what happens at events. And then again, maybe just to link back into that AI to the edge of story I was telling you about earlier, these cameras can now actually film and write the police report. These cameras will eventually connect in with drones, etc., and use drones for policing. So this is a very innovative technology company that's basically providing solutions for public safety and been very, very successful. This is the earnings growth of Axon over time. We are having to pay a high multiple for this company, but it's been a hugely successful investment for the last year, and really, again, just at the start of this opportunity. And then maybe one last thing, since I've got a couple of minutes here, just to talk about healthcare. Again, we're just flagging this AI to the edge. These are a couple of the companies we're invested in. I'll just quickly talk about RadNet, some of the exciting things we've seen this year. RadNet owns MRI centers in the United States. Used to be, a boring MRI company, now has this AI angle, because effectively AI can detect breast cancers, roughly a year earlier, and has shown to find that 17% more cancers can be found at an earlier stage. And so people are more prepared to spend on that because, quite frankly, people don't want to get cancer. The quicker you find it, the better your survival rate, false positives, etc. And so this is a classic scenario of some of the smaller cap ideas that we found in the small cap fund. And this one has graduated to the all cap mandate, whereby you've got a simple company that through the use of AI is going to the edge. And you're seeing this from Pro Medicus here in Australia. The difference is with RadNet, we're paying roughly 15, 20 times EBITDA, not 150 times earnings for a company that quite frankly is doing a very similar thing across a number of its businesses. And so from that point of view, we think that's a great opportunity and obviously a much smaller market cap. And that's come through the small cap team. Okay, last thing just to talk about is short selling. So again, don't overcomplicate this. We're in the third year of a bull market. Short selling is going to be part of what we do, but not a big part, roughly 10% of the fund. And the things you want to be shorting are the really obvious ones. China is clearly a loser here versus the United States. Companies that get hit by tariffs are clearly a loser here versus the onshore winners. White collar industries are clearly going to suffer to artificial intelligence, and we still have some disruptable retail ideas we're looking at. But this is, like I said, not a time to overcomplicate this. The path forward is fairly clear. And our job is just to lean into that and invest our clients' money accordingly. Very quickly, just to wrap up before I take questions on the funds. So just to remind everybody, there are 4 strategies here at Munro Partners now. The absolute return strategy, which combines all of our best ideas with the downside protection. The concentrated fund, which combines our best ideas just fully invested the whole way through the cycle, so more of a relative return product. The climate leaders product that invest in the enablers of decarbonisation, and now in the last year, the small cap product. They're all using the same process. They're all using the same investment team to find, a number of these bottom-up great ideas that I showed you today that will all drive their earnings growth, and that earnings growth will lead us towards our share price growth. Returns, as I showed you at the start, have been very strong in the last 12 months, but that again is very normal at the first or second year of a bull market. Next year, it doesn't mean that you're probably not going to repeat those returns next year, but it doesn't mean you're not going to get solid double-digit returns next year and potentially the year after, because you are very much here in a bull market. Last thing, just to flag, I showed you the positions by the Munro Global Growth Fund. Again, if you go to our quarterlies or our monthlies, you'll find the same thing for the Climate Fund, which is effectively positioned this way around clean energy, energy efficiency, and circular economy. But we do not like, for instance, electric cars at the moment. You haven't heard me talk about that today. And then lastly, if you want to go and see the SMID Fund again, running over the same process, same areas of interest, just different ideas coming up underneath. So these different structural growth ideas underneath. And again, don't be afraid to go to the website and look at some of those. There's a number of great videos that Chow and the team have done. Or most importantly, listen to our podcast where we talk about a lot of these. And all of that is available on our website. So with that, I have said my half an hour. I think we've got about 10 minutes left for questions. Thank you very much, everyone, for listening. If you want to drop off, but for the rest who want to listen to the questions, Steve, fire away.
Thank you, Nick. And we do have quite a lot of questions. And just before we go into that part of it, we've had well over 300 people register and attend the webinar. And so there's been heaps of questions. So apologies if we don't get a chance to go through all of them. And one of the common questions, which I'll address, is you will be getting a copy of the presentation and the recording plus CPD points in the next few days. So if there's bits that you want to look at again, you've certainly got the opportunity to do that. So Nick, as I mentioned, there's heaps of questions, but just picking out some of the common themes, one of them that's come out a lot is, and you referred to it quite a few times, around the bull market. So we've had a lot of questions saying, well, what are likely reasons for the bull market to stall or reverse? Why is your view so strong when we have people like Warren Buffett apparently taking a contrary view? And more economic factors around the sustainability of a bull market relating to unemployment in the US and how these gains can actually continue?
Yeah, great. Okay, so it's important. Look, I think the thing that has confused a lot of people, and including us to a certain extent, is interest rates went from 0 to 5%, okay? And everyone thought that would cause a recession. I thought it would cause a recession too. But what we've discovered is that the market and the consumer is obviously they're not thriving at 5% interest rates, but they're surviving at 5% interest rates. Inflation is now in the rearview mirror, and if you're hoping it's going to come back, good luck, because the reality is inflation is a yearly rolling number. It went up 40%. Yes, it's what's the most likely thing that's going to happen from here? It's probably going to be flat. It's very unlikely prices go up another 40%. So central banks have the ability to cut rates if they need to. And what we want from here is them to cut rates really, really slowly to create this long and sustained upcycle. That's what we're looking for. And I would just point out, I get that people are struggling with this a little bit, but if you remember all the way through this bull market, we were told that this bull market was only happening because interest rates were zero. And interest rates are zero, and it's all multiple, and it's not going to work. Well, guess what? Now interest rates are 5%, and the market's at an all-time high. And so the reason why it's not interest rates that are driving this, it's not the economy that's driving this, it's earnings that are driving this. It's the earnings of the S&P 500. The earnings are driving it because the S&P 500 is not the economy. And so people get really stuck trying to connect these two things together, but it's the earnings that are driving that. And I even showed this here. If you look at this over a really long period of time, the S&P 500 is clearly growing significantly faster than the economy because it is these best companies. And so from that point of view, rates have gone from 0 to 5. The market's at an all-time high, and the reason why is because earnings are driving it. So going forward, our view is based on the fact that we see earnings growth actually getting better from here, and we see it broadening out. So you should have a broader bull market, and valuation is not out of bounds. And the last thing I'd say is most people I meet are not actually invested because they've just had this bad experience back in 2022. That's what normally happens. And so you should climb the wall of worry now, not just for a number of months, but for a number of years. And I'm not saying there won't be corrections. There will be corrections. There always is 5-10% corrections, but you should be able to climb that wall of worry for a number of years now because the setup is pretty good.
That's great. Thank you, Nick. And once again, I'm just sort of picking some of the themes in a lot of these different questions, but another one relates to an area that you also mentioned with America first and Trump's view around that. But the questions relate to what's the flip side of that, and you mentioned China, being probably not winning, for want of a better term, due to that. We've had questions around what's the impact on Asia generally, China in particular, and also with the more protectionist strategy in the US, what does that imply for the US dollar as well?
Okay, lots in there.
Yeah.
And I just remembered I didn't actually answer the first question. So just to remind everybody, so obviously we have a positive outlook. The first question you did ask, what could go wrong? The big thing that can clearly go wrong is geopolitics. And this is sort of part of your second question. So I'm not sitting here saying that the bull market's here and it's all going to be fine. I'm saying mathematically this sets up very well for a good bull market. There are things that can go wrong. We clearly didn't predict COVID. There are things that can go wrong with geopolitics. Our view is to hedge those with put options. And so right now you'll see our funds fully invested, and the absolute return fund, we've got a safety net underneath it, because I'm not sitting here saying nothing can go wrong. Something can clearly go wrong. I'm just saying mathematically this sets up quite well, and we want to be fully invested and then hedge for exogenous shocks through put options in the absolute return strategy. In terms of your China questions, look, the America First policies are just going to favor America, quite simply. That's going to be bad for China. It'll be bad for other countries that do a lot of exporting to the US. And so from that point of view, expect capital to continue to flow to America because we're looking for that earnings growth, okay? And so that earnings growth is going to come in America because they're advantaged by these tariffs. And it's not going to come in these other countries because they're being hurt by these tariffs. That's the simple way to think about that. And the last part of the question you're going to have to remind me was, you're on mute, Steve. You're on mute, Steve. Nope, still on mute. Okay, I'm going to make it up. Yeah, so the last part of the question, I think, was basically from our point of view on China, we are not investing there at the moment. We are not happy with the political environment in China, and how capital is treated in China. And capital goes where capital is treated best, and capital is treated best in the United States. And so I do feel that America First policy will continue. I think I do now remember the last part of the question. What could go wrong with that? Look, I think it is fair to say right now we're in the hope stage of the Trump presidency. A lot of people are going to believe that a lot of things that are going to happen. If it goes like the last Trump presidency, you might get 6 months, a year into it. And a lot of these people, you know, who on paper look quite good, like Scott Bessent, and some of these, you know, people like Elon Musk, etc., that are getting involved, they might get disaffected with Washington and leave. And in the end, you know, the Trump presidency might make up for much. That's sort of what happened last time. The equity market did fine through that period. The equity market actually did fine through the Biden period. And I think it'll do fine through the Trump period. It's just a matter of whether it gets ahead of itself, trying to price in too much of this, say, productivity boom that doesn't actually happen.
That's great. Thank you for that. Just a couple of other more specific questions around the funds and your view. We've got a couple of comments here around you have a sort of a neutral or maybe even negative view on EVs, you know, which, you know, anecdotally, you know, we see them out everywhere, you know, when you're driving around. So would you mind just elaborating on that, please?
Yeah, within our climate strategy, we have a number of we have a negative view on EVs at the moment. The reason why we have a negative view on EVs is because we feel that they're in oversupply. EVs are in oversupply at the moment because, quite simply, there is too much supply coming out of China. Okay, so we've effectively overbuilt electric vehicles. We're not saying they're not going to be adopted. We're saying we have overbuilt too many electric vehicles, and the prices are coming down. And everyone can see that with the Tesla at the moment, which is very cheap and a very good buy, but not very profitable for Tesla today. And so from our point of view, we feel that that oversupply will take time to work through. And as that oversupply takes time to work through, we fully expect electric vehicles to be a good place to invest again. But it's not a place we want to invest in today as that oversupply works through and as China's effectively dumping cars around the world today. Long-term, structural demand towards EVs will continue. And long-term, we feel comfortable that it will come back into the fund as a good play to invest at some point in the future.
It's great. Thank you. And just another more specific question as well. You commented around AI making significant inroads into the medical diagnosis industry. One of the questions that's come through is, what's the implication at the individual company level where you have all these patents rolling off and the value as an investment, you know, will that deteriorate?
So what's going to happen with the AI stuff is who actually ends up owning the data is the most important bit. Our belief is that the data is owned by the MRI centers that actually do the MRI, because that's the disclaimer that you sign when you go into the MRI center. But this is an evolving space and something that we are continuing to work on quite closely. But from our point of view, the leaders here are the companies that actually run the MRI centers and that own the MRIs, and so they have the best ability to monetize this opportunity. And so the simple way to think about this with this particular scan is, if you go to the MRI scan to get a mammogram, what they're doing at the moment is saying, would you like to pay an extra $40 to get the AI to read the scan? And more than 40% of people are prepared to pay the extra $40, because I would as well, to be super sure that I did not have cancer. And that's how they're monetizing it.
And could you just comment on the patents as well for big pharma companies?
Around AI or around?
Oh, well, that's part of it, but also, you know, the impact on their earnings, you know, if they have competitors coming out with more generic options at a cheaper price.
Yeah, again, think about it from the center point of view. Think about it, that the upsell that you're going to get. So yes, there are patents on some of this stuff. Ultimately, it needs to work and it's a price, but how we're thinking about this is it's an upsell on a product. So I showed you Axon earlier. You know, if you weren't going to get the body camera before, the body camera can now watch what happens in the incident and draft the police report. It's called draft one. So that's more likely to sell the product. Does that make sense? Think about the upsell on the MRI scan. That's you're more likely to get an upsell. Think about we're all users of Microsoft. Copilot will create the upsell. And so the patents is not really that important. It's more how useful is the product, and how much more do you have to pay for that extra use case, where there's clearly a use case and people will pay for it. And so all of these companies have that opportunity to monetize that upsell, if that makes sense.
Yep, that's great. Thank you. We've got time for one more question, which I might ask you to answer in your summary as well before it comes back to me to conclude. But the question is, and it's one without notice, but what's your top stock pick for 2025? And maybe we'll just after that continue into your summary, please.
That's not fair. Yeah, so I think I'm going to hold off on that actually. I think, ultimately these are the areas of strong structural growth. These are the companies that we think can win from it. And so what we're saying here is there are strong structural tailwinds that equal strong structural growth. NVIDIA is still the biggest position in the fund today. So in theory, that is still, one of our best ideas for 2025, and it is. I do think that NVIDIA is the AI and software. It's the hardware and software winner for AI. And so if you believe AI is going to be big, then NVIDIA can still get bigger from here. On top of that, a number of our climate ideas are obviously leveraged to the power that's going to be supplied from that. A number of our software ideas are leveraging that as well. Down the rest of the curve here, you're basically investing in companies that are broadening out the recovery. So companies that are benefiting from the infrastructure build out in the United States, companies that are benefiting from the America versus policies of Donald Trump. And then lastly, you've got these great ideas where AI is effectively an add-on to it, i.e. they've got leverage from that. There's a number of those good ideas in here. There's a number of those good ideas in here. And there's particularly a number of these good ideas in the small cap fund. I'd love to pick one out for you. I'm not going to, because I'm not allowed to give stock advice on a retail investor webinar. And so from that point of view, I would just merely point out that all of our funds are identifying the area of structural growth. That structural growth will equal earnings growth. That earnings growth will equal share price growth. We appreciate your time for dialing in today. If you'd like to know more, please go to the website. And most importantly, for those of you on the webinar who are investors, thank you very much for your support. We really appreciate it.
That's great. Thank you, Nick. And just to conclude, on behalf of GSFM, I'd like to thank you also for tuning into the webinar. I hope you found it very insightful. As I mentioned before, we will be sending out copies of a recording, the slides and your CPD points. If you do have any questions, you're welcome to contact your GSFM account manager and we'll definitely help you out. And just to reiterate my comments at the beginning, all four of the Munro funds are heavily represented on all the main platforms. We do have the 3 ETF structures, and one of the common questions that came through was, will we be launching an ETF for SMID? That's something we're considering. It's not imminent, but if we continue to see the demand, we certainly want to provide as many access structures as we can for advisors for their clients. It's been a fantastic year for the Munro funds, and it's been great for us knowing that a lot of your clients have enjoyed that performance. We're really excited for 2025, and we thank you all for your support. And once again, if there's anything we can do, just get in contact with us, and we're happy to try and help you out. So on that note, we'll conclude, and once again, thank you, and have a great Christmas as well. It's only a month away, and if we can send any info, just let us know. Thank you.